We're back. Another all-new episode of The Compound and Friends. We have two fan favorites back with us today. I'm very excited to welcome back Leanna Haakons. Do I pronounce that right?
No.
Okay, do it the way I'm supposed to do it.
Haakons, like Black Hawk Financial.
Okay, who said? Are you sure about that?
It's true.
Okay, all right.
They call me the Hawk since I was 19, a little wee one in the industry.
Leanna Haakons is back and ready to crush today. Welcome back. So nice to have you.
Thank you.
You're dressed up the way that we are for St. Patrick's Day, but somewhat against your will. I feel like you're not as...
I'll take an all-black New York look with the green tie.
I'm with you. All right.
That's where I draw the line.
All right, very cool. Dan McMurtrie back in the house. Dan, say hello to everybody.
What's up, everybody?
Dan just got back from Vegas for, what did you say, 4 days?
Yeah.
Okay. How long ago, though, did you get back?
Sunday night at like midnight.
So it's Thursday. You're okay.
Yeah.
You're by now it's enough. When are you going back?
Hopefully never.
Okay. And Mike was not in Vegas recently. What's going on with you? Everything good?
Let's get to
Ready
it.
to pod?
Yeah, let's get to it.
Ready to get down to it?
Ready.
Mike doesn't do small talk. Did you guys know that?
I mean, when that's not what we're here for. Let's go.
Mike's a pleasure to meet, like in real life at a party. Go up to him and be like, "Hey, how's it going? I don't know. What do you need?" All right. What are we starting with?
John, throw up this chart. Why don't we start here? Value of investors' revenge. Not that chart. John, slacked you. So, all right, I'll set it up. It's been a minute. The last couple of years, like almost going on a decade, Dan, you know better than me, has been rough for long short investors, which are traditionally like long cheap, short expensive, which has been like the widowmaker for way too long. And you know what?
Yeah.
I'm happy for you all. It's been too much pain. So we're on the other side of that. We're looking at Berkshire divided by ARK, just ripping up and to the right. What is going on? How are you doing? How are you feeling?
Wait, the Berkshire ARK ratio chart
Yes.
is back at 2017 levels, having erased 5 years of pain for people that actually look at things like earnings and book value.
Yeah, it's pretty awesome
game now.
to have a little bit of something make a little bit of sense.
Is what he said true? Are most long short investors value oriented?
I don't know that that's true anymore. I think on a maybe by count, but by AUM definitely not. The last few years, all the AUM went to really growth oriented, quant and growth oriented managers. For long short fundamental, it skewed massively growth.
Okay,
But even within that, you would still say long quality short junk.
So what happened was basically over the last like 5 years, if you look at statements that a lot of prominent hedge fund managers made, there was this progression of them kind of giving up their tools. So they said, okay, first we're not going to do anything that's not TMT. Then they said, okay, we're not going to short. Then we're not going to do small caps. And like right at the moment where they kind of got to this point where they told all their investors,
long only NASDAQ 50
right,
is what it turns into.
Right when they got to long only NASDAQ 50, that was exactly the top. And then it's been really, really bad.
Who's the value investor that literally shut it down at the top? I feel bad for that team.
There were several.
Yeah.
And there are, now you're seeing the growth guys start to get unwound. And the issue is you have a lot of guys who launched, call it 2014 to 2018, had okay records and had one or two awesome years and then have immediately given all of it back. And it's not that there's credibility issue with their LPs of, how do you assess that manager's skill looking at that record, because it's so clear that so much of it is single factor driven. That's really, really tough.
Isn't it smarter though to just shut it down and then when your environment comes back, make your comeback? No high watermark.
Look how quick it happened.
Leanna, could I get away with that?
The value of the long-term relationships, though, is what's tough, right? Like you can't just say, hey, we're going to put a pin on it here and come back in 2 years when what we were doing initially is in favor again.
But wait a minute. But what if I'm like, you guys, I was dead serious about retirement, but the fat pitch now is so obvious.
Right.
This is I would almost be selfish if I were to keep this talent and expertise to myself, given the macro environment being so favorable to what I do.
Are you looking for a fundraising job?
I mean, yeah, I guess you're
Could I get away with
media
that?
marketing guy.
You could do it once, right? You could probably do that once.
But also, you had to pull that off in like 3 months.
That's what I'm saying. How so quick?
Yeah.
You had to call it right. You had to move.
Well,
really
wait a
fast.
minute. Is that true? What if this is the start of a 10-year cycle of value outperforming growth?
Could be.
Is that possible? Have we
be.
ever had that? No, not really.
Value tends to get kind of like 4-year runs. It seems like historically. The Fed, in their guidance yesterday, kind of said they think that we're going to have this 1-2 year period of inflation, and then we're going to go back to low growth, low rates. They took the terminal
They're usually
rate down.
right.
Powell said the value one has just started. I think that's what he said. I'm not quoting exactly, but
Powell said we're going to have a value regime.
Right, yeah.
going forward.
Well,
Right.
I mean, but we could sit here and feel really bad for hedge fund managers all day, right? But
I feel good for them.
This is what they want.
this is,
Dispersion.
I think all of this is really good education. Everything that's happened, especially in the last years, is such good education opportunity for retail investors and young investors, millennials that are now starting to make money and want to get into investing. Like, I know that we like to talk about things in our industry and the professional investors, but I mean, your audience on the show is the retail people too, I think, and that's, who I talk to with financial literacy and my stuff on social.
Well,
so
for them, like a lot of the retail investors that just started probably had the mindset like, why would I ever buy anything that's not TMT, tech,
Right.
media, telecom?
I think it goes both
And now they're
ways.
going to have to learn oil stocks.
Well, that's what's funny. I mean, me personally, I'm more of like a value-oriented investor, but that's
That's
also
the
'cause-
Canadian in you, though, too.
Probably. I'm
Yeah.
just,
Resources.
fight for the underdog,
Yeah, yeah.
resources. But I think it's also just a factor of what I'm personally interested in. I don't know a lot about technology. I don't care a lot about technology, but when it comes to money, I do sometimes. I usually find the men in my retail investing space that I talk to or message me on Instagram, that type of thing, if they're in the technology or software business and that's what they're interested in, personally as a retail investor and in their careers, they're going to be more prone to looking at the growth stocks because they're hearing about them. They actually know what that technology looks like and the prospects for the future. Whereas me, I'm not going to bet on that growth horse as much because I don't know about it. And the valuations seem so freaking high. So I naturally gravitated to the airlines and resources and everything in the last couple of years.
Is what Dan said about the last couple of years, like corroborated by what you've seen, which is that the only real way to have raised money in recent years is to raise it for a growth fund.
I mean,
Like,
yeah.
that's who's getting the flows.
Well, it's turning to crypto now, which is something I'm really into and invested in. But
Which is value in a way.
Yeah.
in a way. So Dan, who are the winners? Give it to us. You have this provocative take.
Give us 10 stocks that are going to work this year.
Yeah.
Tomorrow.
Yeah.
No, I mean,
Duncan, zoom in.
Look, there's a lot of complicating factors in the market right now. You have inflation, you've got supply chain, you've got real wages moving all over the place. You've got all this stuff happening. Kanye,
a lot going on.
A lot
I
going
agree.
on. I just think it comes back to price matters. Like I actually right now I don't have that much of like a sector bias because I think there's been this big regime shift from basically buy things that go up to people going, holy shit, nothing works. And I think you can go back and across sectors, like right now there are a lot of companies that are, you're not going to buy this idea that you need to buy the best business. That's going to go out the window. And people are going to go back and look at, okay, what actually makes sense price versus value, which is supposed to be the whole thing, right? That's the point of value investing. Value investing is not don't buy software. It's not don't buy retail. It's get a good price. But if you go out, just making up names, you can go buy, Target at 14 times. You can buy Williams-Sonoma at 11 times. These are earnings. You want to go into industrials or staples, you can get things at 7, 8, 9 times cash flows.
Right.
And so the economy might fall off a cliff, but it's probably priced for there. And even though there are some things that are, I think, causing things to decelerate in the economy, the consumer is just roided up and bulletproof right now. The consumer doesn't have any leverage on.
But if you're long only, it's a different conversation than if you're long short or someone that has the ability to hold cash. Like if you're long only and you think the economy is going to fall off a cliff, you just be like, well, what will hurt me the least?
Right.
And of course, that's going to lead you toward lower valuation stocks.
But wait, hold on. We was talking about like the consumer. So we just got an email yesterday that was interesting. Somebody said, when I started listening to y'all, I never thought I would lead to quality Disney World advice. My wife and I were debating about the Genie Pass, blah, 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 blah. We went for it and it was key. By the way, parks are packed. They are speculating that this might be the busiest week ever in the history of Disney. Recessions are different than I thought they would be.
Yeah.
Because these are people that this is just pulled back demand. Half of these are trips that were canceled 2 years ago.
So my point is, like, it's so weird to figure out where we are in the cycle, where we are in the economy. Like, can we go into a recession and the consumer still be like bulletproof? Is that? It seems to be like totally incompatible. But maybe we have a weird thing that.
Well, the amount of savings are still higher now, like consumer-wise, than they were pre-pandemic. So, and people have pent-up demand to get out and do stuff.
Can we have
a
a general slowdown of the economy with things still on fire? Or does that totally not make sense? Or
I think so.
we can't have that.
People
In the
at
short
Disney
term,
this
yeah.
week, two things about that. The people at Disney this week, probably a lot of them were supposed to have been there last year or a year before, promised their kids, and it's a makeup trip.
Right.
So it's not like more money being spent.
Right, but what
it's just time
percentage?
shift.
What percentage of overall consumption this year is going to be stuff like that? Like
Oh, a lot.
Every
69.
dinner. Like, what about you guys? Every dinner I get invited to is, hey, haven't seen you in 2 years.
Yes.
Come to dinner. You got to go to that dinner.
A lot.
So-
I agree with you. And the travel stocks, I think, are reflecting that. Like,
I mean, right now flights are booked. I mean, it's
didn't
crazy.
Delta just say they had their busiest 2-day period ever?
It's nuts.
I'm on a trip this summer that was supposed to be 2020. So,
Yeah.
like, I think a lot of people are. And I don't know if a downturn in the stock market is really going to affect that this year.
Well,
I think
think
people are like, I'm doing it.
Housing's still really strong, and I think the other thing, I tweeted something about this, but I don't think it's appropriately analyzed. If you look at the options a consumer has right now, if you want to reduce spending but keep the amount of stuff you're buying the same, if you go from, like, for example, the classic thing in restaurants is getting pizzas delivered versus picking them up at the store.
Yeah.
If you go get them, if you go pick up the pizzas, it's $6. You feed a family for $15, $18. Versus getting delivered, you're going to pay $35, $40. You go through DoorDash, you're going to pay $45, $50.
It's so funny. We just did that last night.
Right. There's so many options for the consumer just to say, you know what, I actually care about that incremental $20 or $30. And you can recoup a lot of the gas pressure and things like that from those costs just by making little tweaks. Like maybe we're going to do more Costco and we're going to do less, Whole Foods.
My kids were on Uber Eats ordering Wingstop last night, which is not supposed to cost what Peter Luger costs.
Right.
And I'm like, before you hit enter, how much is that? And my daughter's like $32. I'm like, where is this place?
It's right at Sunrise
Right.
Highway.
It's on Sunrise Highway. I said, you know what?
Drive over there, spend 5 minutes,
Yeah.
spend $12.
The $8 or $9 is not life changing, but I'm driving there.
The service charges on a lot of things. Actually, two interesting points on that. Pizza, let's start. Domino's, have you guys seen the new incentive that the carryout pickup they have? They give you credit for every order if you pick up carry out instead of delivery. They give you, I think it's $5 or $6 credit.
It's probably cheaper for them than
They're
trying
gonna
to
pay
find
you.
delivery
It's cheaper
people.
than trying to find delivery people, hiring them, reimbursing them for gas. I do Instacart and stuff, living in the city, get groceries a few times a week, produce and things I don't want to carry home, quite frankly. So all of the service charges, some of the service charges, it used to be like $3.99 for $25 of whatever, and now it's $6.99 just in the last few weeks. So all the service charges on the delivery things are going up. That'll eventually hit the pocketbook, but in the short term, it's not going to affect demand.
How great
I
is
don't
it if, like, the new economy is the less lazy you are, the less things cost you, which I think is how it should be.
That's a frugal, healthy perspective.
I kind of feel like that would be cool.
It
I
kinda
might
makes
start
sense.
walking to Whole Foods again. We'll see.
That you should pay less to exert less effort, right?
Well, like insurance companies try to incentivize people for not being fat slobs and sitting around all day. So, like, why wouldn't the actual economy work that way too? Wouldn't that?
Well, that doesn't work. But
No, I know it doesn't work.
But I mean,
I
yeah, the
just
rest
mean
of
it
the
would
economy,
be
yeah.
nice if that were an incentive out there.
Dan, what's this crazy chart that we've got from Blake LeBaron?
Agent-based model
What the
of
hell is
asset
this? What is
prices.
this?
Okay.
This looks like you got
Something tells me this is going to be over my head.
Yeah, mine too.
No. It's not that complicated. Okay, so basically, there's a paper which Jim O'Shaughnessy retweeted. It's great. And this guy, I think this was published in 2001. He basically created a computer system that made up random trading strategies. And he basically assumed that if the trading strategy loses over a certain amount, that manager gets fired, right? And so he just has those managers, those theoretical managers, just run money, and the winners get more money and the losers get less money.
As a simulation.
A simulation.
Yeah.
And what he essentially shows that over time, you have a reduction in the diversity of strategies. You end up with a bunch of strategies that are mostly the same. They might all be momentum. Some say they're growth. Some say they're outright momentum. And what you see is the market is really good at pricing whatever when you have the wisdom of crowds, which needs diversity of opinion, right? And so the point is when one style works really, really well for an extended period, every other style gets crowded out of the market. So you can see here, on the top, you see kind of the price trend. And on the bottom, you see rule dispersion, which is just like how different people's strategies are. And so look where they reverse. It's always you get all of a sudden everybody's strategies are basically 40% the same right there where it says 80. And then the price tanks, and all of a sudden all these strategies come back. So this is what's happening with gross versus value, et cetera. And it's kind of ages old as time.
This is an argument for having multiple managers or multiple strategies inside of your portfolio.
Because if you don't have that, what you're seeing there is in the short term you get smoother returns or maybe higher returns, but you're taking an immense amount of rebalancing risk, and you're also making a bet that you're going to make the smart rebalancing decision.
Time it right.
Really, well, not even if you miss it. once you tank, are you then going to make a smart decision when you're down 30% of your portfolio?
No, you do the opposite.
But the problem is, isn't this the nature of markets that eventually people will throw in the towel on what's not working for such a long period of time? I was looking at a 3-year chart of small cap value versus ARK. And ARK was up like literally 300%. And small value was up 30 over the same time. And it's like a 4-year period. That feels like an eternity. You're like, all right, clearly this shit is broken.
Right.
I'm gonna stop inflicting this pain on myself. And then from today, like it literally crossed all the performance gave
right
back.
right at the moment, though.
Right at the moment of maximum pain. But there's no avoiding this. This is what markets do, right? And we've been in a weird period recently where it's just been so long.
No, the only way you avoid it is with asset allocation and making sure that you have, if you want to be a little tilted, it generally makes sense to basically play the hot hand a little bit. But so many people, especially people coming out of the tech space, they start with, okay, I work at Facebook. I have a bunch of Facebook stock. I'm going to diversify into Google, and then I'm going to buy a little Amazon. I'm going to buy some CrowdStrike. I'm going to buy some NetSuite, whatever it is. And all of a sudden, you've got a guy, fast forward 3 years, private banks are saying, hey, why don't I lend you some money against your shares, and you can buy more stuff and do venture. And then all of a sudden, they've got a leveraged long portfolio that's all one bet.
Yeah.
And that's where
some
real,
of it's illiquid now too.
Right, and that's
Yeah.
where real
great.
pain happens.
People tend to buy what they know as a retail investor or start there. So
I actually think it's easier for individual investors to like stay away from this shit than it is for professionals.
it is once they actively start thinking about it or they see their portfolio like it looks right now and they're like, what the beep was I thinking the last 5
Because
years?
individual investors don't have outside capital like chirping at their ear and after like literal years of underperformance, I don't know how people could like stay sane and not give in.
I got a
redemptions.
I got a DM from a guy, all in tech guy, retail, and he's just like, I'm gonna watch this commodity rally instead of sell all my tech shit and buy it, because I know the minute I buy it, that's the top for commodities and the whole thing's gonna reverse. But if I were to do it, it would be right at this moment.
Right.
And literally that was WTI crude at 130.
Right.
Like he knew it.
Right.
He's a retail guy, but he knew I feel so compelled at this moment to sell all these f***ing social media companies and just buy Chevron. He goes, that's how I know it's over, because I'm literally about to do it. And he was dead right. So
generally, when you
retail
get that,
guy, but he knows himself.
When you get that feeling, like one of the things we spend a lot of time on is very similar to poker, trying to like really feel how you're feeling and thinking about how that's influencing your investment decisions. And the one that kills
Is that
you
a Peter
is,
Frampton song? What's
Probably.
that song? Do you feel how I feel?
Do you
Is
feel
that-
how I feel?
You.
Oh my God.
Yeah.
You.
But if you're
Well done, Michael.
Thank you. Thank you.
if you're feeling like making that trade will be relief, will like make you comfortable.
It's so bad trade.
Do the opposite.
especially when it's adding exposure. It's always the worst possible time.
Or what about when it's like, oh my God, everybody is getting rich?
Oh, I heard you talking about this with Frederick at the bottom in March 2020. Like, if you like literally feel compelled, then you should have the not you should. It's hard to be the self-aware that everybody else is feeling this.
Right. It was a buddy of mine who's been a trader a long time, and I called him. It was like the 17th or something. It was like right around the bottom, and I'm like, dude, what do you think? This is crazy. And he's like, honestly, he's like 11 a.m. today. I felt myself begin to vomit. I felt my stomach going.
From what?
From just the
March.
market vol.
In
March of 2020.
Yeah.
He feels himself begin to vomit. And he goes, I go to grab for the trash can, and then I stop and I go, wait, I felt this before. Everybody else feels this. I need to buy. And he put his entire account in like 2 or 3 ETFs. It was like small caps, miners or something. And then just shut his machine off and bailed.
Yeah.
And it was the best trade I saw of the year.
It's the hardest thing to do. What is this China-focused long-short managers? What are we
So
looking at here?
that was just something somebody posted. Which
John,
was
you
just,
have this?
Yeah, that was just an example of like, people are saying hedge funds are back. Hedge funds are not back. They're having actually a really bad
How many
year.
China-focused long-short managers are there
Quite
in
a
the United
few.
States? Is that a huge category or?
Not so much the United States. A lot of them are Hong Kong based, but basically everybody's getting tattooed, but particularly the Asia focused guys. U.S. long short's been really, really rough again because I think of the growth bias and that getting unwound.
Imagine selling this track record. Like imagine sitting
right. This is the cumulative of everybody.
Yeah.
And it's
Well,
it's
let's
pretty painful.
let's give some people some of the highlights so they know what we're looking
So
at.
America's on the right. America's average long short, America's fund is down 9.49% for the year. Event-driven down 7.41%. Again, these are strategies supposed to be hedged or
Right.
not correlated.
Josh, remember a month ago I was saying these long short guys must be like killing it right now.
Not everyone.
Well, the issue particularly in early March is you got a couple days of like really violent unwinds, and so during those individual days, just none of your modeled correlations hold up, and so you have to make sure that just on the other side of that, you still have liquidity to kind of reinstitute the strategy. Usually, it comes back if you know what you're doing, because over time not taking that much beta is one thing, but it's almost impossible to have no beta on any individual day. Like that's very, very hard to accomplish, and especially when you have these violent kind of top-down unwinds.
So I want to get your take on like the growth stuff, like what's going on. I saw this tweet yesterday or the day before. Somebody wrote, Zoom, which is the company that became a verb during the pandemic, is down 12% since the pandemic started, which is mind-boggling. In that period, revenue is up 5 times from $830 million to $4.1 billion. Operating margins are up 4% from 4% to 28%. And look at this chart.
Yeah.
When I looked at this, I was like, this looks like Piton over the last 3 years.
Yeah, it does. It looks
And
exactly
obviously
like that.
completely different companies and fundamentals, right?
So yes, I understand that these things obviously were overvalued. I think this is one of the weird things where consensus was right so quickly. In 2021, everyone understood that this was going to be unwound.
But they quintupled their revenue.
Yeah, but the
And I
part
don't
that
think they're losing
the
it.
part that I don't really understand is that these companies are like below pre-pandemic levels with such bigger businesses.
They were very. I mean, where
Is
on
this
that
just an
where on that
unwind?
chart? Where on that chart do you think people bought?
Right. So it's
And that's
just,
the
it's just this is not fundamentals. It's just an unwind.
Yeah, I think everything that's happening right now is an unwind. I
So
mean,
by that logic, like, are we going to see like? And I'm not commenting on Zoom. It still might be expensive. Who knows? But like, there's going to be some like fabulous buying opportunities.
absolutely.
Am I too bearish on Peloton? I think it's a 0.
I actually did a poll about this on Instagram
That's
last
the right.
week.
That's the right place to do it.
Looking at a lot of your
Well, you did a
people
poll.
follow
You took the poll on Peloton. What
on
did people
Peloton if you'd buy it at this level or not.
Where is it? $20.
Not even, I don't think. Let's
Peloton
see.
violates one of my 3 laws of investing, which is
Oh,
1, Americans
to
are
us.
fat.
Yeah.
2, moms be shopping.
Yeah.
3, know that company's not going to cure Alzheimer's.
Yeah.
Those are the 3 rules.
Those
that
are
will allow you to survive.
anytime. Is it anytime a company is involved with at least one of those rules? You're saying
Pretty much, yeah. I
Okay.
will not. Anybody mentions Alzheimer's, I'm out. You know, anybody's like Americans are going to be healthy, I'm out. And
Yeah.
anytime somebody's like moms love this, I'm like buy.
Why? Oh, you will buy
Yeah.
on that.
Anytime it's like our core consumer is like the upper middle class mom, I'm like I'm so in.
So wait,
I want
yeah,
that.
Moms
what if-
definitely love Piton, but I think all the ones that were going to buy it already have it.
It,
That's the
it
problem.
conflicted
Yeah.
with Rule
They have it
1.
But that's
Right.
what
Problem.
it's so different. Like, just, I mean, you can pull up the 3 to 5 year chart of Piton. I'm looking at it right now. It looks wildly similar to Zoom. It's almost at the exact same level it was. Now it's at 23 or 24 today, but it's almost at the exact same level, if not slightly below pre-pandemic.
I think even the bulls at this point, their argument is that someone's going to acquire it.
Yeah, that's why I would
Well,
say
there's
throw
no
some
other argument.
speculative money in it if you don't care about
So
it.
then why do they have to acquire it at this price? Unless you tell me there's a bidding war, why can't they just wait till this thing really dwindles away? And then,
I think they will.
if in fact that's what has to happen.
Yeah, I don't know technically with Zoom or with Peloton what their support levels look like right now, but I would say Piton, throw money at it if you want to do a little bit of
Zoom's
gambling.
problem is
but
no
that's it.
switching cost. Like if you and I have a Zoom meeting and then I Google Meet you, you don't care.
Yeah, the Zoom thing confuses me obviously a lot more than Peloton. What do you think? Do you look at Zoom or?
I've looked at both of them. I think Zoom's a good business, but 0 switching costs. I also worry that some of these things will be negatively associated with the pandemic.
Forever.
Right?
Yeah.
That's a concern I have.
It's
I
not
think-
good to be in a pandemic ETF
Right.
a year after
There's
the
a lot of
pandemic.
But
there are
5
a
years
lot of
down the road,
flows.
won't everybody still be using Zoom?
But
And who cares?
Now I'm seeing like most of my meetings are not coming across as Google Meet. Like it started 100% Zoom, then it was like a little bit less, a little bit less.
We're getting a little bit back to phone.
There are
meetings, which I
people
love.
that
think
will be
Teams
forever
is killing it.
associated with the pandemic. Do you
Yeah.
know that?
Yeah,
That's
for
not
sure.
good. Like
Yeah.
I don't think Fauci will ever not be pandemic Fauci.
Oh, but he loves it. I mean,
will he still though when we've
I don't
moved
know.
on to something
Let's talk
else?
about like the recent market action. Throw this chart from Sentiment Trader. This is a good one. So this is showing the Nasdaq Composite after consecutive 2.5% gains following a 52-week low. This is fairly unusual, and it tends to happen more often
What's
than not
unusual?
near market bottom.
2.5% daily gains.
back to back after a 52-week low.
That is a bottom.
That's a bottom. I mean,
Historically, that has been the bottom.
It's 1, 2, 3, 4, 5. This was the sixth, and 5 out of 6. 4 out of 5 previously happened at a bottom. The only one that didn't was that 2008. I can't say from your hat.
Is it possible that seven instances just really isn't enough to tell us much?
No, because this tells you. I mean, yeah, obviously it's not 100 times, but this to me this is a meaningful chart. After a 52-week low, you have back-to-back 2.5% gains. Like that's capitulation. That's a bottom usually.
So when did this happen? This week?
The last 2 days.
Okay, go to Bespoke's chart below that. What is this saying?
This is showing that. Now this is a broader look. This is just showing that back-to-back 2.5% gains. Generally speaking, like that does not happen during a healthy market, right? So you saw a lot of those. So there's been 27 times. 11 of those came during the dot-com bust, like on the way up and on the way down. 4 happened on the way down in 2008, 2009. I mean, a ton of volatility is not indicative of a healthy market. In fact, it's the exact opposite.
Even when you get a plus 2.5% day, that's probably because you just lived through a negative 6% week or something.
Right.
If somebody pitches a strategy right now and says that it's total addressable market is like the types of stocks they're choosing, do they get punched in the face or laughed out of the room?
Well, that's a bull market strategy.
Liana, if you ever hear that term again from a professional, what's your response to that? Like, I'm buying the companies with the biggest TAMs.
Yeah. I don't have a prepared statement for that answer. However, I do think that this is probably the wrong time to be trying to sell that sort of strategy. But in a way, it's kind of like some of the stuff in digital assets and crypto is selling it a little bit the same way. Yeah.
But TAM is a private market thing. People, like public investors, I feel like don't really say that, do they?
No, they do. That's the problem.
They
that
were
crossed over
6 months ago.
6 months ago.
That was
how
definitely
people were
used as like a
investing.
key term.
Fine, but if you're
sales
saying
pitch for
if you're
public.
pitching the TAM when you're already $40 billion, like shouldn't you be like hitting that TAM?
Well,
shouldn't you just
that was
have
the
revenue?
Zoom story the whole way along, right? Is that we
Yes.
still have this much growth
True.
and this TAM, like
And then there were multi-TAM stories.
Wait a
Like,
minute.
what
don't.
happens if I get into that business too?
Insta short.
Like, what happens if Amazon is all of a sudden doing health insurance?
Well, I
What's
think
TAM?
this pitch of the TAM was a big thing around like the year of IPOs, 2021.
Do you know what the total addressable market of this podcast is? Like, in theory?
I don't know, but I know that because
Like
I'm here
7
today,
billion.
it's definitely a lot bigger.
7 billion. And actually, if we break that down into ears, it's 14 billion ears.
Wow.
Could potentially.
Sponsors must love that.
All right,
pitch.
so now maybe it's gone too far. I'm hearing TAM stories stand for total annihilation of money, which maybe that's a good thing for these stocks. This entire philosophy of investing, though, I think has just been murdered. And historically, I feel like this type of thing takes like 10 years for people to ever revisit once again. Like once something has done this much damage to investors. So if you're coming public in the next year, you probably don't have a slide in your deck talking about your total addressable market.
Probably not.
I think that's maybe the worst thing you could say. I just threw this in really quickly. The effect of the NASDAQ crash feels like it's already being felt in VC, maybe not in crypto, but this is data collected by Carta, which provides equity management and other sort blah, blah, blah. Carta is like if you invest in a private company, you log into Carta and you could see if there's any shareholder notifications or if there were any rounds or whatever. They're basically saying Series A to Series C stages in the United States, prices are already in decline. Valuations for those deals are already falling. It's a whole thing at TechCrunch. Mike, this is like as soon as we thought it would show up or sooner? What do you think is going on here?
I didn't read this yet, but my take was that Instacart, for example, is already a public company that just happens to be private. And it was actually, we just spoke about this, that Fidelity marked it down by 18% since they invested in February 2021. DoorDash is down 70% over the same time, which is hilarious. T. Rowe, a little bit more conservative. They marked their investment down by 5%. Okay. So here's the coup de grace. Instacart, they're carrying it at a $32 billion valuation. DoorDash is 26, and DoorDash has 3 times the revenue.
It's tough.
That's
a big lift.
That's a bold strategy, Cotton. So I think that these like growth equity areas, again, they are publicly traded. They will have to get marked down, but I still think that like Series A and seed, like I think that they're going to be, I don't want to say immune, but like, I don't think those valuations are coming down anytime
What
soon.
percentage of the hedge fund business started like really getting involved as either becoming crossover funds or sponsoring SPACs?
I got a great chart.
I feel like it was like 10%. I'm just making that
I got
up.
it.
but-
No.
Number that in 25 maybe.
What's
The
that?
question is, are you doing it by firm count or dollar basis? Because all the big ones did.
So
Every
here,
big hedge fund was a
here.
SPAC
Here,
sponsor.
look
It
at
was
this.
free money.
Look at this. So this is non-traditional investor participation in private markets. Who is that?
Oh, it's my watch.
77% of dollars last year, 77% of the $330 billion raised came from non-traditional investors. That's bananas.
Meaning not venture funds.
Bananas. So these people are pulling back. But again, I feel like the entire Series A market, like all of it, is still a tiny dollar amount. So I think that can still be
I think early
silly
stage is
for a
fine.
while. Yeah.
The earlier that's Michael's theory is the earlier the stage, the less sensitive.
Because why?
to-
If you're a pre-seed or seed or whatever, and you're trying to build a business that might have customers in a year, might have like some real market value in like 3 years, why do today's valuations matter? Number one. Number two, if it's a $15 million valuation, who gives an F? It's such a tiny dollar amount.
Yeah, but if you have to think of it in the way of like an investor's mind, every dollar that they're giving to someone means something. And the valuation of that from the get-go is always going to be sensitive, particularly when you look at the way that technology is performing right now in the broad market.
I was going to say exactly that.
It's a
Sen-
mindset thing,
it's a
right? It's the
mindset.
sentiment of the sector right
If you had
now.
5 stocks blow up, and then the 6th one is a private company asking you to write them a check, like you're definitely writing a lower check than
Yes,
you otherwise would have.
if-
I don't care what stage they're in.
Yeah.
Well, okay. Well, that's
You're in
where
a
we
bad
disagree.
mood.
Fine.
If you're a
But I feel like-
crossover
Because you're
fund-
angry.
I feel like
You're a tech
if
investor.
you're a seed, like there's a floor. There's just is a floor. So if the floor is 8 million or 6 million, all right, what is the difference?
Well,
You look like you have a SPAC announcement coming. You want to make it now?
the issue with the venture market is everybody kind of copied what I guess Masa and a few other people started doing, which is just these nuclear orbit strike amounts of capital where you get a company that's kind of proven the concept and they go, okay, I'm going to give them so much money that nobody would dare else come into
Try to
this,
compete.
right? Or, we're just going to go scorched earth and we're just going to spend $200 million and we're going to hire every salesperson with a brain in the industry. We're going to just get all the distribution. And the issue is if you pulled that off and you could kind of show the right charts, you could get these crazy multiples and the math actually worked.
Did that work for what company did that work for? What startup did that actually work
WeWork?
for that didn't blow up?
Well, WeWork
WeWork would be a very bad
WeWork was
example.
the famous failure, but Yahoo is the original one, I believe. So Sebastian Mallaby, who wrote More Money Than God You've Got on the Wall there, just came out with the Power Law, which is like similar history of VC. And I think he goes through Moss's investment in Yahoo. And the funny thing talking about Yahoo is like everyone was aware that Yahoo's trash or Yahoo's technology was trash. It was just terrible. And Masa just said, who cares? I can just buy the market and I'll flip the stock out and I'll make an insane amount of money. And so he was making the IRRs on his money were just made up numbers because it was kind of like with poker where he just decided I'm going to play so aggressive that nobody else is going to be able to keep up with me.
Meaning all of those other early search engines looked at the amount of money Yahoo had in its coffers and threw in the towel.
Yeah, Yahoo could at that point basically they had so much money that even if they were doing everything pseudo manually, the other people couldn't keep up with them. And Google needed a few more years. That wouldn't work long term, but it was a great trade. But you saw the same things happening like, we were short Grubhub at one point. And the reason we were short, a lot of our shorting is competitively oriented. So a lot of the reason we were short Grubhub was not really specifically because we had issues with Grubhub. It was just that DoorDash raised so much money in the private market and had been very clear that they were going to use that to attack like a psychopath with an axe. And I remarked to a friend of mine, I said, Grubhub is locked in a cage with a psychopath with an axe. It's not going to go. Meanwhile, Grubhub's like, we have positive cash flows. I'm like, that is not the strategic move.
Yeah.
When the other guy has $300 million to just
you
fire
have
you.
5% market share,
Right.
but you have positive cash flows.
Right.
You picked the wrong.
By the way, I saw a tweet yesterday that Masa is down $25 billion.
I mean, he's a fast, loose, super aggressive player. Like, that's what he does.
Yeah.
And he always kind of, the guy's a king.
Yeah.
Like, no disrespect to Mas at all, but, like, his strategy is super high vol.
Yeah.
You can't do that right now. I guess you can.
Well, he can.
But it's
Many
not
people
paying
can't.
off.
Yeah, it's tough.
Okay. Let's pivot. Fed decision yesterday. Does everybody feel like money got a little bit tighter overnight?
I was going to get Kobe ice cream yesterday, but it was like, dude,
in this economy.
25 basis points. I'm sorry, you have to wait.
All right. So Powell said, in my view, and I'm the person in charge of this, the probability of a recession over the next year is not very high. I feel better. How do you guys feel about all this? Feel okay?
Well, for me, I mean, I'm not managing money, or I'm not managing anyone's money other than my own. So it's not like this interim volatility that I see it as is not a big issue for me. It's not a big, I advise people in, the stuff I do on social and millennial investors to not try to be bothered by this. Stick to your plan and know that the market's going to be volatile. No, we get corrections here and there. That's fine. Take these as opportunities and look 5 years out, 10 years out. Yeah, don't give a damn.
I know they should be praying for corrections.
You might not like it as much, but I'm looking at everything.
Powell said labor markets are, quote, tight to an unhealthy level.
Yep.
Meaning we need more unemployed people, but you can't say it like that.
No, we need more immigration.
Should he be canceled for that statement?
I mean, I think everybody should be canceled at some point.
I agree.
I'm an immigrant.
We should get over it and say we need more immigrants. But that's actually the solution to most of the economy's
Immigrants
struggling.
get the
No, but we
done.
need like the right kind.
Like Leanna. We need more Leannas.
more Irish.
Yeah.
The economy is so weird right now.
I like Trump's immigration policy. If they're pretty and thin, let them in.
Okay, let me tell you, I came in during that one.
That's right. That's how we got.
I may as well have been from Afghanistan. It was tough.
So, but he's actively saying the labor market is too tight. Does that mean there are too many jobs open?
There's 1.7
or
jobs
too many
for
people
every
earning a living?
worker.
It's not the stuff.
But it's a weird place to get to.
Yeah.
You run interest rates, real rates, negative for 2 years, and then say
They're still very negative.
Things are too good.
Actually, good news. Lisa Abramovic tweeted the volume of negative yielding bonds has fallen to the lowest level since 2015.
Yeah, that is good. What's this yield
So
curve chart?
we've got yield curves inverting all over the place. Who's just? Where did I put
Here's
this
the
tweet?
issue, though.
What's up?
I put a thread in the chart. The Modest Proposal was a great Twitter handle. Put up a kind of thought experiment of what would a recession look like, and so he kind of worked through. Okay, a
That dude
recession.
is so smart.
Crazy, and he goes. A recession would have to come from corporates investing less or the consumer weakening. And the issue is, you go look at the consumer. And I've been trying to do this. It's really hard to figure out how the consumer slows down here, or goes negative at least. Incredible balance sheets. If you think the consumer is going to cause a recession here, you're making a bet implicitly that for the first time in American history, the American consumer will choose to not overdo it. That they're going to say, okay, I still got a lot of savings. I'm not going to go to that credit card. I'm just going to calmly
I don't know.
take it down.
February retail sales missed. I think that March retail sales will be worse. And I think that almost all of that has to do with what it costs to fill up a gas tank at the pump.
But here's the question, right? The question is that a trend, or is it people going, holy shit, gas prices, then they get used to it, then they kind of recalibrate? Because when people see big changes quickly,
yes,
right? I think the street is a little bit ahead on the narrative of consumer spending being weak, because what they're seeing is people going, holy shit, this price moved. But that doesn't mean that it's just going to be this snowball of them spending less and less and less. I think people are just kind of adjusting to it. And wages are still growing, pretty damn strong. I think it's slightly negative on a real basis.
Real's not great.
But
even let's say it was break even on a real basis. That's still a net negative for consumer sentiment. And the consumer sentiment surveys are falling off a cliff.
Sure.
And those typically lead consumer spending. Again, it could reverse. And if there's a ceasefire and all of a sudden the price of oil and gas drops quickly, we may digest the price rise and see the consumer rebound quickly.
How about a recession that doesn't tank the economy, where it's just like a mild recession?
We don't do that anymore.
Well, I mean, I think that's the thing. So there's the consumer side, which is just, I think the issue is that people saw a very rapid increase in prices, but it also didn't stop. It was one way. There wasn't any volatility. It was just a trending market, and that really freaks people out. And now you're seeing oil sort of form a range. And I put in the notes, I think chartists are having a field day right now because, pick a major chart, S&P 500 on a monthly or oil, whatever. They're all behaving like textbook technical analysis things.
Yes, because those are the only people left with capital to trade or
everybody else
technicians.
is anybody who had any beliefs is dead.
Right.
Value
can
guys
only
died
believe in
first.
trends.
Then they came for the growth guys.
I like your idea. I hope that's what it turns out to be. Is
But on
that
the
we
flip
digest
side,
it?
and this is something that was in that modest thread, was it's actually, again, if you go over to the industrial side, you go, okay, corporates are going to invest less. If you actually look at where the nominal dollars are coming from, like the actual just big number, no adjustments, is Microsoft going to invest less in the cloud? Is Google?
They just invested in
Is
Consensus.
Amazon?
Did you see that?
Yeah, like the question is, are the major corporates, are the top 50 corporates really going to invest less?
No.
Are the defense companies going to invest less?
Definitely not.
It's actually very hard to see.
Oil and gas capex
Okay,
will be
even
up.
look at autos. Look at autos. All of them, they
full speed
invest or
ahead.
die
I agree.
for them, right? So the issue is on the corporate side. I can't find many corporates. I'm concerned about inflation because every company I'm listening to or talking to is saying, we think inflation is going to moderate in the next 6 months, and also we're raising prices in the next 6 months.
Yeah, we're passing it on.
Right? And I'm like, that's not how that works. But I can't find a company that's not investing right now.
That's a really good point.
Right?
The
And
cure
so-
for high prices is stimulus checks.
There's
Right.
also a couple points there, Josh, with what you said about gas prices and stuff too, is pandemic has boosted online sales and e-commerce. I actually just brought up a little stat here. So online spending still only represents 21% of total retail sales.
That's crazy.
But that's up
Feels higher.
44% year over year from 2020 to 2021.
That's the crazy part.
And that'll continue. So I think gas price is not as much of an effect on consumer spending. I think it'll have more of an effect on the continued boost in travel and what happens with those companies.
It's funny that they waited for everybody to move to the suburbs and get their first SUV.
Right.
That they had to wait 6 months for because of a microchip.
Dude, you know what I
and
saw?
then they're like, okay, double the gas price. We're ready
I
now.
swear to God, I saw a Hummer H2 on the street the other day, and I was like, oh my God, it's 2003. It's literally
Those were
brought them
the,
back,
those,
though,
those were
didn't
the
they?
dumbest trucks ever.
Were they still? I didn't even know
I didn't even know
Hummers
they
were
existed
still
anymore.
No, they
existed,
brought the Hummer back.
But it was an H2. Did
Yeah.
they bring back the H2?
There would be no reason to do that.
Right. That's what I'm saying. I was
Unless
like,
you saw
what?
Arnold
And it was the
Schwarzenegger.
original yellow paint job. Remember that?
Yeah.
There is an EV one now, right? For real?
But is it the H2? That was the thing I was really confused about.
sure.
Yeah, there's an EV Hummer either on the street or coming, and
Right.
that's like a big part of it. All right, who is this
Me.
Rabobank quote from?
I'm Rabobank. So Rabobank is like a European bank. They said, actually, before we get to that, let's look at some implied yields. So the implied yield on the December 2024 Euro-dollar future contract is 2.39%, which is 28 basis points below the year earlier contracts, indicating that traders expect the Fed's benchmark rate will be cut over time, which is hilarious. So to Rabobank, they said, quote, we are now...
Look at this.
Oh, wow. That's a fat one. I was thinking about the
No.
H3.
And I looked it up.
this is
They
the big
stopped
boy.
production in 2009, so it's just
God.
Yeah.
someone
Sitting on the
still rolling.
sitting on the
Good
street
shit.
in Queens.
That's hot.
So Rabobank said, we are now pricing for a policy error and the inevitable rate cuts and new QE that will have to follow. In other words, just as the Fed drives things off a cliff, Mr. Market is already pricing in the trampoline at the bottom that will take us to even higher highs.
Yep.
What's
When's the
funny, what's
the
funny
next
about
QE?
that
When's the
that
next
quote
QE?
is just
the
like
rate hike cycle from 04 to 06 was,
It's just so we can cut again.
was 17 individual 25 basis point moves every single meeting. The rate hike cycle that ended at the end of 18,
3? Was it 3?
9.
9? It was 9?
I know that now consensus is 7 because that's what the dot plot says, and we just had the first of 7, or there's 1 and 7 more. To Rabobank's point, I can't imagine it. You already have, I think, 2-year, 5-year, and 10-year are within 3 basis points of each other.
Right.
So we're going to now deliberately
throw
invert
up,
the yield curve.
throw up this. So
I can't imagine 7.
The
I'm
5
sorry.
the 5-year I think just went above the 10-year. The 20-year is above the 30-year. It's all messed up.
The 20-year yield curve is above the 30. The 20-year yield is above the 30-year yield.
Yeah.
It's funny. Right, already. That didn't take long.
I think the 5 is above the 10, but I'm not positive.
I think they're equal, or it could be inverted already.
And
I don't know.
2s are skyrocketing.
Well, yield curve control is something a bunch of the economists are talking about. Is do they decide to go and intervene and specifically try to influence
Target
durations?
the later duration.
So what would they do? Try and push down to 2? Or
sell
what?
it? No, sell the 10-year.
Just
right?
try to buy and sell to create the shape on the curve you'd like, essentially.
Buy the 2s and sell the 10s, and
Right.
and steepen that way. I mean, I don't know if they could really
The
do
Fed,
it.
the
but
Fed should hire Renaissance to run that for them.
Right. Yeah.
I feel like you could do that.
They've done it before.
They should get the what's his name, the Chewy guy who's buying GameStop and Bed Bath. Be like, look, you need to get these treasury
Ryan
prices
Cohen?
up.
But the point is, how frequently do rate hike cycles just end and then nothing? Or is it most of the time it is a policy error at the end and the Fed is already back to cutting a la 2019?
I just don't understand. This sounds weird, but from a consumer standpoint, why are you really that worried about? Like right now, the consumer has a big bankroll. They have access to credit. Everything's pretty good. Yeah, mortgages are up, but home prices are up so much. Rents are also going in a certain direction where buying still makes sense. If things get really bad, I think the American public expects more stimmy checks. Like I think that's the end of the day. And so I think everybody's just wondering like, okay, how long are we going to do this charade of hiking before we get back to more stimulus?
You can't do stimulus checks simultaneously with the job market is too tight.
Right.
And there are 10 million
My
job
point is,
openings.
if it gets
True.
bad.
I know, but like just think like what are we even saying at that point? Like politically.
We're out in like a
This is another planet.
There's like
I
no
honestly, this is
control.
why I feel like there's no historical precedence. History is junk right now. It tells us nothing. Things are so
Well,
weird right now.
No, so I'm going to ruin your audience for a second. So there's this book called The Price of Peace, which is a biography of Keynes.
Oh,
And
that's
it's-
amazing.
It's insane. It's such a good book,
Yeah.
and it's talking about him being in the room when they're deciding like how are we going to do World War I and
Yeah.
Versailles and the New Deal and all this other stuff. And it's a really good read right now because it's talking about the social, personal, political, mathematical angles of environments where the rules are being made up as we go along.
Yeah, because
Which is where we've been the last-
environment.
Yes,
right,
yes,
right.
yes, yes.
And what you see if you go back and you look at that, which is 1900 to 1950, is every time the government does anything in the last few years, you got these guys on Twitter who are like, "This has never happened before." Bullshit. You just not well read. This happens all the time. There's a guy on New River Investments, Guillermo Roditi, who's fantastic, and he always says the only rule of financial markets is that the rules change at like exactly the wrong moment. I think we're just in another one of those right now, where
Stimulus checks,
Yeah.
but employers can't find people to work is literally unworkable politically, and any politician that's for that is going to have a really tough time explaining why it's necessary. However,
what if we go into a recession, all of a sudden the jobs go away?
well, so that's the thing though. If you have 10 million open jobs, you go into a recession, let's say half of those jobs disappear, you still have 5 million open jobs. How can you get unemployment to go back to 10%? I don't know if you can. Is everyone going to be an entrepreneur and launch their own crypto app? I mean,
God willing.
I mean,
willing.
I have a coin coming out soon.
You make a good
I'm
point.
totally kidding. But there's just so many things at play. Like we haven't even touched on Russia, Ukraine, like
Right.
the end of a 2-year global pandemic coinciding with like people talking about World War III, where there's just so much shit going on. Like, how is anyone supposed to actually forecast what this is going to look like economically for
I agree.
investment managers, consumers? Like, what are we even talking
great
I'm
about?
one of the
Great
only
point.
idiots.
I
that-
feel so bad for. I don't want to be these guys changing the yields and the rates. Like that.
I think like Ukraine is more meaningful to markets than the Fed right now, just because
Of course.
the bond market already tightened 7 times for the Fed. So
Yeah.
there's little he could do other than a 50 basis point hike that would shock anybody. The real surprises are coming from the war and
Yeah,
the price of
there's-
oil as a result.
so many like geopolitical things that need to settle down and give us some clarity or a little bit of guidance, I think, before anyone can
Strong
really
close,
speculate
FYI.
You got
how
a-
this is
you got a
going
war
to
view?
play out.
Yeah, well, I think the issue
War
is
is bad.
War is
For
bad. I mean-
or against? We're gonna make.
He's
We're
totally
gonna cut
for
this
war.
clip for Instagram. So
I think the issue is 2020 was so crazy because we had what most people would consider an act of God happen, and human society, broadly speaking, just said no. We're canceling that. We're just going to print money, stimulus. We're going to whip up a vaccine in 4 months.
yeah,
I mean, it's outrageously amazing that we pulled off what we did. And setting aside the vaccine issue, part of it was we had all these levers we could pull with monetary and fiscal policy because we didn't have inflation, because there was no risk of prices going crazy. And we had a crazy backstop. Now we're in this position where our options are much more limited.
yeah.
Right? And so any incremental risk, whether it's Russia, whether it's China, like pick a topic,
Variant.
it's variant. All of those things are now much more serious in terms of the severity of what can happen. Like it's not at all a given that we can handle unknown unknowns.
At almost zero interest rates, having done multiple rounds of stimulus, what do you do to confront the next thing?
Right.
The genie's out of the bottle
We
already.
just had the strongest 3-day change for the S&P since November 2020.
Yeah.
I'm bullish again. I don't know about you. I want to pivot to Citadel has to talk to the public now. This is in Bloomberg Business Week. Citadel was thrust into the spotlight in 2021 with day traders, lawmakers, and regulators all scrutinizing the firm at the center of one of the U.S. stock market's wildest periods. They're less a hedge fund than a market maker, I think, in the eyes of most market participants
They
at this
have
point.
both, but they're different businesses.
Right. They're about to learn that amid the uproar, the financial giant had its best year ever. So they posted record revenue of $7 billion. They cleaned up on all the volatility, topped the firm's previous record, which was the year before, 6.7. All right, so in the pandemic period, Citadel made itself like $13-14 billion. And now they've decided they're not just going to sit there and let people talk shit about them, but they're actually going to go on the offensive. My first thought is definitely hire some meme people and maybe ramp capital. And like, what better way to communicate with the public than Twitter trolling in 22? What do you think?
I mean,
Is that the alpha
how do you
move?
address a largely fabricated issue? Like,
What's the fabricated issue?
I just think this whole like conflict that it's like retail versus Citadel. Look, if you're trying to high frequency trade on your Robinhood app, it might be you versus
They have
Citadel.
a 40-year-old CEO, and I doubt he's really the person making the decisions here. I'm sure it's still Ken forever. This is his quote. "You get to a point where staying under the radar is no longer an option. We want to be able to tell our own story rather than having the story told about us." Leanna, when are they hiring you to do this?
They say they're getting into crypto market making too, which is a big opportunity.
Well, that's
Clean
not
up.
controversial. That's a good idea. What would
I
you,
should be running that.
What would you advise them as far as starting to talk with the public? What should and shouldn't they do?
I mean, I think that they have to be sensitive to what their reputation has been thus far.
Hasn't been good.
Exactly.
That's why they make so much money.
So they got to play it safe. But at the end of the day, I mean, if they're like bringing in buckets of money, like people are going to want to know why, how, what's the plan forward. And I mean, I don't think it's that big of a deal.
Why would they care about their reputation in the comments section?
Because
Who
they
gives a
don't
shit?
want to face Elizabeth Warren once a month
Yeah, but
in hearings. The
Yeah,
next time the stock
this is
market
like
melts down.
This is like a thing. It's like Michael, when did you stop beating your wife?
Yeah.
Never.
When did okay? Well, yeah, it's like that type of thing where it's just
Bad
like
joke.
it's
Bad
like a
joke.
it's like a ridiculous. The structure of the claim assumes that they did anything. I still can't figure out what Citadel actually did. This just seems like a
They
meme.
democratized the markets
I don't even know what that means.
very
Good for them.
profitably.
You know.
But they brought democracy to the stock market where once there wasn't any. Listen, I think Ken Griffin should just pretend he's like all into ESG. That seems to have worked for some other asset
Has it?
managers we won't mention. I don't know. They seem to get left alone.
Rhymes with Black Hawk.
They should run around just talking about like governance and all the women they've hired. Isn't that enough? Like, what else do they really need to do here?
They need to buy the Constitution.
It'll be interesting to see what they do. I still vote for
Ken
memes
Griffin
and
did
shit.
say that he likes to play Call of Duty, and so I think he needs to live stream himself just brutally trash talking some children.
If he goes on Twitch and literally like plays Call of Duty like against
Right.
Alvin Kamara,
And wins.
like 100%.
Alvin
Yeah.
Kamara.
He's got to
anyone,
do
famous
that.
athlete,
Or he's got to box, what's his name, the YouTube guys.
box
the Pauls.
Jake or
he's-
Logan.
Yeah, he's
Logan
got to box
Paul.
Jake or Logan Paul. That's the two ways out of this. And then the internet will collectively say, okay, touche.
Yeah, we
sir.
like this guy.
Yeah,
And then he can clap back at Elizabeth Warren on Twitter like with aplomb.
right.
And everyone will retweet him. I agree.
well, you know, it looks like, I mean, just with this starting, it looks like they're having sort of a PR new plan of how they're going to move going forward about being more transparent and hopefully gaining some trust. And good luck to them.
All right, stock picking. Turns out
How is this possible? This blew my face. This
Turns
stat.
out it's not easy to do. There's something called the Spiva. Well, I'm Italian. The Spiva scorecard that is S&P Dow Jones tracking active managers versus their benchmarks. 85% of large cap managers underperformed the S&P 500 in 2021, which means 15% outperformed. That's one of the worst years on record. And in large cap growth, it was 98.6% underperformed. Why does it seem like it's getting worse, not better? I mean, it's
So to Dan's point
It's hard,
earlier
dude.
about crowding, I thought finally FANG underperformance, finally these poor active managers that keep underperforming have a chance to shine. I'm like genuinely rooting for them. And what in the world?
Is it because nobody owned enough Tesla? in 21? What were the stocks that killed you if you were active last year and you didn't own?
Tesla was definitely one that was brutal because a lot of guys were. It
It wasn't even in the benchmark the
right.
whole year.
That's the problem.
Right.
I don't know. I mean, I don't manage long only money. I think it's really, really difficult because you have to figure out how to blend, not just your fundamental views, but where the actual flow is going, all these subsector things. It's really, really tricky.
Dan, do we still have too many active managers? Like,
That's what this says to me.
Is
but
it just?
I could be wrong
Is it
about
just
that.
like there's too many smart people fighting each other to the death, and they just can't win? Like,
Well,
what the hell is going on?
Yeah, it's that, but I also think it's an issue of scale. So these funds now, the funds are getting so large, and the fund houses are so large that, like, a big reason why, certain factors will underperform in a given area is just investors pulling money away from small cap value and putting it into large cap growth or something like that. You have this issue where there's just not there are a lot of managers, and there's really not that many underlying securities that you can put enough money into as a $20 billion or $50 billion fund. Like, I have no idea.
a universe of
Yeah,
50
it's a
stocks
lot.
that'll move
It's
the needle.
harder to be nimble and adjust the bigger that you grow.
Right. And there's a finite universe of stocks that will help you
Right.
if you get them right.
Right. And at the end of the day, at that point, it's really about who else is at the poker table with you versus the cards, because you are the market when you move in or out.
I thought last year would have been a better year for active.
Yeah.
Given how much sector rotation there was.
Right.
And how little contribution came from like Amazon.
And last
Google
year,
didn't-
But that's also kind of betting on timing, right? Like, how quickly can you move?
How
When
quickly
those
can you
sector,
get into
like,
the new trend?
85%. How is it even possible?
The other thing that happens a lot with those mandates is the things you would need to do to win are not
do.
necessarily what you've told your investors you're going to do. So I'm going to make tactical timing calls on a week-to-week basis. And if you fail, like, it's one thing to lose money, but if you lose money in mandate, nobody's that mad. But if you lose money out of mandate, you're fired.
Do you think?
So if you started buying like heavy concentrations of energy stocks in the fourth quarter of last year,
Right.
if that didn't work, it did work.
But if it didn't, buy.
If it didn't, that's your job. It's not like, oh, you weren't good this year.
Right.
Your job is gone.
Do you think that if managers had the opportunity to like close it up and not let investors see what they were doing, they would outperform or perform better?
Yes.
Over how long can you close it up? Because these are
I know
annual.
you can. I'm saying theoretically.
Maybe
If
some, but some wouldn't, and that's the problem. There's some
that's
people where you're
probably-
like, what were you doing the last 3 years? Like, I don't think a black box is.
Right. It doesn't really work with like the agency costs. Like, it's not, that's not gonna. There are some funds that, like, they're funds that raise money once, they're private, then they close, they never raise again, and some of them have done spectacularly well. Other ones, the investors find out 5 years later that all the money's gone.
Yeah.
Right. It's not. And then your ability to raise money under that type of structure is mostly determined by how did the last one of those go for that individual LP.
Right. So somebody's still buying your old track record no matter what.
Right.
Okay. Chinese stocks had a huge rebound. Do we want to say anything? Michael, what do we want to say about this? This is pretty surprising how quickly.
That was a Russia thing.
What do you mean?
Everybody, the day after Russia invaded, leading into Russia invading Ukraine, you had a lot of like very prominent Russia experts saying there's no way this happens, and anybody who says it happens is an idiot. And like, there are very, very strong opinions on this. And I was kind of sitting there like, I don't know anything about Russia. It might happen. Who knows? And then it happened. That evening, I got
The invasion.
right. That evening,
Yeah.
the invasion, I got 15 to 25 phone calls of, holy shit, dude, do you think this means Taiwan, or do you think this means China's going to go for Taiwan?
Everybody said that.
Right? Everybody said it.
Yeah.
And then when the sanctions got dialed up and they started really going after SWIFT and Russian assets, all of a sudden the VIE structure, all these U.S. listed China stocks, you don't
What's
actually own the
VIE?
stock. So there's a thing called variable interest entity, I think it is. VIE, basically, when you buy Alibaba on the exchange here, you're actually buying a
Cayman piece of paper.
Right.
That
You're buying a
represents
piece
the
of
stock.
paper here
Yeah.
that owns a Cayman piece of paper that has a contract with a company in China saying that they'll basically hold on to the Chinese ownership for you. But there's no actual like direct tie to the actual cash flows. And so that's something like Chanos and people like that have said that's ridiculous. You don't actually own the stock. That's been the bear case for a long time. But nobody cared because everybody kind of played ball. And I would note the Chinese government never like fully affirmed that was legal. It's just been like this, it's fine, we won't talk about it thing. But the second the West decided to shut down all the Russian assets, all of a sudden it was like, holy shit, these things actually could go bust. And I think you just had like a force. All of a sudden you had, career risk.
Got it.
I think you said that on like
Yeah,
a
yeah.
podcast.
Well, the China funds were saying, actually, we're going to buy the Hong Kong version. Like
Right.
they were bailing.
That's why KWeb
Right.
is 70% in Hong Kong now.
They
Right.
did that quickly, right?
It's been over time, but I mean, they knew that like the writing was on the wall. They can't do ADRs.
So if KWeb is giving up on VIEs that trade on the New York Stock Exchange, then
time to
why would
buy.
anybody else want to stick with that strategy?
Right. And so it got sold to that view. And then there was a day where China came out and said, actually, we're not going
Yesterday,
to go crazy.
Yeah.
Right. And then
4 o'clock in the morning, East
Right.
Coast time.
John, throw up
Yeah.
this KWeb chart. So
They did say they had CraneShares CIO on last week when it was really dropping, and
Shouts-
obviously
shouts
I
to
started
Brendan.
buying it. And then
look at
he said, yeah, now they've moved into 70% and they're going to continue that strategy.
so there was literally like names up. So we're showing the portfolio weight versus a percent change. Nobody can see this, but let's throw up the Bloomberg chart, which is the yellow and green stuff. So some of the moves that we saw yesterday, I think KWeb was up 40% yesterday, 37% was the biggest up move
40%
ever.
one day.
yeah.
This is nuts, though. Like the degree. You have stocks in this index that are up 80% on the day.
You know what that is, Josh?
Even
Even
I'm
look-
looking at.
That's a healthy market.
Yeah. No, it's an efficient market.
So even Alibaba, which is I don't know what's
Baidu
now.
went up 40% yesterday.
My favorite is Joe Weisenthal goes on when there's big price moves.
Is he
and
the
he's
best?
Like, he's like, the market has repriced the cash flows.
So it's Munger that's Alibaba now, right? That's what everyone's talking about.
He did. He was a buyer, right?
Yeah.
Put this.
I don't know what it was. I was just looking at this last week and early this week. Every day I was putting a little bit into KO for just me personally.
Good for you.
I love Munger, and
Were you really?
I'm a little bit suspicious
I
that
had
he
a
just
little-
like he's
Eric
like
Balchunas.
he's not certain that he's gonna have. He wants another good argument with somebody, and so he's like, you know what?
before the end.
Yeah, he's like
One
like
last.
I could definitely have a he loves to argue, and so I feel like he's maybe just being like, yeah, this will be fun.
It is really funny. And one thing I'll say about Chinese internet stocks in general, I feel like this is what the crowd is here for. Like if you're somebody that's investing in Chinese internet stocks, you don't think you're buying insurance stocks. You know what you're doing. You know what this market is capable of. And so this has got to be a little bit a little bit fun for the people that are
Well,
like
that's my view on it personally. That's why I've been putting some money into it. And then yesterday it was like, yay. But what do you guys think as in the wealth management space professionally with clients that are asking you, how do we get access to Chinese growth exposure with all of this stuff going on? Is KWeb an ETF like that the best way for retail to get access?
So from our perspective, well, yes, if specifically you're looking for tech exposure in China, that is way superior than picking a Chinese tech stock or 3 Chinese tech stocks.
Yeah.
Because you don't know if the one you picked is being run by the nephew of the prime minister's rival and he wants to make the guy disappear.
Exactly.
Because he didn't bow low enough. So clearly you should do an index approach. But I do think that question of can you even own these at all, if the next big conflict after the Russia thing, assuming the world still continues, is between the West and China, I don't know what these stocks are going to do in that situation. So,
but I guess that's why yesterday was the pop.
and that's why they sell at 9 times earnings, because the market understands that is a permanent risk.
Yeah.
Permanent cloud hanging over.
If
these
anyone is
stocks.
interested, I actually started. It was one of Eric's, Eric Balchunas from Bloomberg ETF analyst, his Trillions podcast, where
Yes.
what they did an episode with a China analyst, and she spoke about KWeb and gave a really good breakdown of some China opportunities, and that's where I started thinking about it a couple months ago.
You had good timing yesterday. What are you going to do now? Let it ride?
No, I sold a little bit.
Okay.
For a short-term gain. But we'll see. I mean, I bought it initially. The idea was it's been on my watch list for a couple months, KWeb. And then when this started happening last week and it was dropping, I was like, well, I'm not looking at China exposure for a year. I'm looking at China exposure for 10 years. So why not put a little bit in? And then got a little surprise yesterday. So.
Speaking of exposure, Nick Cage is back.
Cannot wait for.
Are we really excited about this?
You guys-
I'm seeing this in the theater.
I just can't. I mean, I went to Wikipedia and I looked up Nicolas Cage. I went down the entire list of films and I'm like, I don't think I've seen any.
He doesn't
Stop
make
it.
Any of
films.
these?
He makes movies.
Stop it. None?
I seriously, have you looked at the? He's younger than me.
Not the recent films, but like
all of them.
classics.
The Rock, Con
The
Air.
list starts from 1982 And that the very first one, Fast Times at Ridgemont High. I know that name. I'm pretty sure my dad watched it a bunch, but I can't even.
Wait, what is he in Fast Times at Ridgemont High?
It says Brad's Bud.
Raising Arizona was a film that
I hated that movie.
I never
That's
heard of
good
that
music.
either.
Coen Brothers.
yeah, I know.
I've heard of like Time to
Not
Kill
that.
and stuff, but I can't even think of
Time
these
to
films
Kill?
in my head.
I've
yeah.
seen all these movies. I'm so
Of course you have.
Okay, I
Have you
think.
Have you seen
Oh,
this?
So-
I've seen all of them. Yeah.
So two
What?
things.
Maybe
I
it's
think,
a guy thing.
I think this is going to be, a lot of his movies are guy movies. I think this is going to be the biggest non-Marvel movie of 2022. Like the biggest
Big call.
non-superhero. That's number one. Number two, Rotten Tomatoes. I don't think I've ever seen this before. Rotten Tomatoes audience score is 100 out of 100.
No, there was no audience score yet.
No, all right, so what is this then?
It's like this is bullshit. It's like the pre-score.
What do you mean it's bullshit?
There's no
They're
audience
lying.
score.
They're saying it got 100 of 100 on Rotten Tomatoes. People have seen this film, Michael.
Hang on a sec. This is
Oh,
nonsense.
critic score.
Yeah.
The Lionsgate comedy has already generated a 100% critic score on Rotten Tomatoes.
That means nothing. But I'm psyched. I'm psyched. I'm psyched.
I don't think that any other film has ever gotten that. That seems like
Seems like a bit is what it seems like.
Yeah, you're giving too
seems
much
like a
credit.
meme.
It's funny. I wouldn't think that a Nicolas Cage film would fit the South by Southwest audience.
Well, it's somewhat artistic in the way that being John Malkovich was somewhat artistic.
That was
it's
a
like
movie.
self-referential. It's about the movie business.
So wait, what's the best Nicolas Cage movie
I
ever?
mean, there's 19 reviews on that score, though. So who are the 19 people? Producers,
they're-
directors, crew?
They're film critics. Yeah,
My
yeah.
favorite Nick Cage movie ever
Nick Cage's relatives.
is
All
Matchstick
voted
Men.
right before South
That's
by
a good movie.
Southwest.
Right, Matchstick
Your
Men.
favorite or a good one?
My favorite.
Okay.
I'm not saying the best. It's my
What
favorite.
do you got?
Con Air.
Good for you.
Can't
that's
go
like,
wrong.
That's like saying McDonald's.
Yeah.
Yeah.
No,
I
like
got
it, though.
nothing
Nothing
on
wrong
you
with
guys.
that.
Differentiated.
Leaving Las Vegas.
That's a good one.
Come on. I mean, the acting. Nick Cage acting alone, I think is his best thing he's ever done.
Darla was the prom queen. Is her name Darla?
You're actually a movie person. What's the best Nick Cage film?
Adaptation.
yeah, I liked adaptation a lot. I mean, if you're talking about like film
What's-
school type films,
That one lost me.
I really liked Raising Arizona. That's probably my favorite.
What's when they steal the Declaration of Independence?
National Treasure.
National
National
Treasure. is
Treasure.
a-
Oh,
that movie is a national
incredible.
treasure.
Yeah, it is.
Gone in 60 Seconds.
Yep.
Where he's a car thief.
That's with Angelina.
Angelina.
Jolie.
So you saw that one.
I know that, yeah.
that one you
That
know.
was a car one.
Face Off was a good one, obviously.
Face Off classic.
He's been in some.
Wait, let me see
Ghost
that.
Rider.
Let me see this.
You remember Ghost
He's
Rider?
been in some pieces of shit.
Oh, he's made.
That's the
as
thing. I thought people made fun of him because his movies are terrible.
He turned into a meme, but he used to make good movies.
Recently.
No,
he
he's
became a
when you
punchline.
make as many movies as Nick Cage has made, you are the distribution. He's
Yeah,
made
yeah.
every level.
So he bought like Tyrannosaurus Rex skulls and like ran out of money and.
Okay,
did
here's what's funny. Here's why people make fun of him. Just can you look at the cover of? I never heard of this movie. USS Indianapolis.
Exactly.
Men of Courage. Just the look on his face. It's right there.
Men of Courage.
Oh yeah.
Just-
Yeah, he's
Ew.
ridiculous. He's
He's
a character.
parody of a parody of a parody.
Oh, yeah.
I want to meet the women who want him in that film.
How about-
'cause,
I want him.
The interview where he's like,
No.
do you go over the line? Do you remember that interview?
All right.
I just
hey,
always think of the SNL one where they have him and Andy Samberg as him
yes.
inside the cage of
Well,
Nick Cage.
He also has a very imitation, like easy to imitate way of speaking.
Oh yeah.
And it's hilarious. All right, let's go to favorites and then we'll get out of here. It's St. Patrick's Day. Everyone wants to have a
Get
drink,
up.
I assume. Get f***ed up.